It's pretty amazing when you think about it. How does a massive company like Apple and, say, a tiny corner coffee shop speak the exact same financial language? Well, it all comes down to one surprisingly simple, perfectly balanced idea. In the next few minutes, we're going to unpack that idea, and you'll see how it's the absolute key to understanding the health of any business out there. Let's dive in.
So let's start with the big question. When you look at a company, how can you cut through all the noise and really measure its true financial health, at a glance? Is there one single source of truth?
Well, the answer is a huge yes. And it's not some complex algorithm or a secret formula only Wall Street knows. Nope, it's a single, elegant concept of balance that's been the bedrock of accounting for literally over 500 years. Let's see what it is.
And the best part? You absolutely do not need an accounting degree to get it. The core concept is something you probably already use when you think about your own personal finances.
Just think about it this way. If you take everything you own, your car, your savings, whatever, and you subtract everything you owe, like a student loan or a credit card bill, what's left over is your net worth. It's the wealth you've actually created. Business works the exact same way. This simple, common-sense idea is the absolute heart of all accounting.
Okay, so we have this intuitive idea, right? What you own minus what you owe equals what you're worth. Now, let's just give these ideas their official accounting names. I promise, there are only 3 key terms you need to know.
First up, assets. This is basically all the stuff a business owns. It's any resource, like cash in the bank, inventory on the shelves, or the equipment it uses that's expected to help them make money in the future.
Second, we've got liabilities. This is pretty straightforward. It's everything a business owes to someone else. Think bank loans that have to be repaid, or maybe bills from suppliers that are coming due.
And finally, what's left over after you take what you own and subtract what you owe, that's called equity. This is the owner's actual stake, their piece of the pie. It's the value they truly personally own in the business.
So when we put it all together, we get this, the single most important equation in all of business. Assets equals liabilities plus equity. Now let's just pause for a second and think about what this is really saying. It's saying that everything a business owns, its assets, had to be paid for in one of 2 ways. Either by borrowing money, which is a liability, or by the owners putting their own money in, which is equity. There's no third option. That's why these 2 sides have to always be in balance.
Okay, so the equation has to balance. That makes sense on paper. But businesses are constantly moving, right? Buying, selling, borrowing. How does this balance actually hold up in the real world? Well, this is where the system gets really elegant. Let's look at a few examples.
This brings us to a key concept called double-entry bookkeeping. Now, that might sound complicated, but all it really means is that every single business transaction has 2 equal and opposite effects. For every action, there's a reaction that keeps the equation in balance. Let me show you what I mean. Let's go back to our coffee shop. It's going to buy a brand new, top-of-the-line espresso machine for $70,000, and they're paying for it with cash they have on hand.
Okay, let's break this down. Take a look at the change row here. The shop's assets have just shifted around. They've traded one asset, cash, for another asset, the equipment. But notice the total value of their assets hasn't changed at all. So the equation stays perfectly in balance.
All right, next up. Business is great, and the shop wants to expand. So it goes to the bank and takes out a business loan for $250,000. How does taking on debt change the picture? Well, here, both sides of the equation move together. The shop's cash, which is an asset, goes up by $250,000. And at the exact same time, its loans, a liability, increase by the same amount. So the whole equation expands, but it stays in perfect equilibrium. And finally, let's look at the best kind of transaction, right? Making money. The shop is buzzing all day, selling coffee and pastries, and brings in $15,000 in cash. Now this is where the owner's stake in the business really grows. The shop's cash, an asset, goes up by $15,000. And on the other side of the equation, the owner's equity goes up by the exact same amount. Why? Well, because those profits belong to the owner. It's their business, so the money it earns directly increases their personal stake. Still perfectly balanced.
So we've seen how these big transactions work. But what about all the little day-to-day stuff? Paying salaries, buying more coffee beans, the electric bill. Let's zoom in on that equity part of the equation to see where that all fits.
You might be wondering, where do things like daily sales and all those little expenses explicitly show up in this big picture formula?
The answer is, they've been hiding in plain sight this whole time. every single one of them is captured inside that equity component. Every dollar earned and every dollar spent directly changes the owner's stake in the business.
And this brings us to the expanded accounting equation. See, equity isn't just one static number. It's a living story. It's the initial money the owner put in, plus all the money the business has earned, its revenues, minus all the costs of running the place, the expenses, and minus any cash the owner has taken out for themselves. All of these things tell the story of the owner's stake.
Okay, so we have this incredibly powerful equation that keeps everything perfectly in balance. So what? What's the big payoff? Well, this equation is the direct blueprint for one of the most fundamental financial statements in the world, the balance sheet.
This quote from our source material just says it all. The balance sheet, which gives you a snapshot of a company's financial health at one single point in time, is just a detailed presentation of the accounting equation we've been talking about.
And as you can see right here, it's a direct one-to-one match. The two sides of the equation correspond perfectly to the two sides of the balance sheet. That's exactly why it's called a balance sheet, because it's a physical representation of this fundamental equation. It has to balance.
So, we'll end with this. The math is always going to work out. That equation will always balance. The real question is, what story is that balance telling you? Is the business growing its assets through profits, or is it just taking on a mountain of debt to do it? Understanding this one simple equation is the very first step to reading that story